Hi, I'm Rob, and today I'm going to be analysing the pharmaceutical company GlaxoSmithKline, also known as GSK. This is my third stock analysis video, with my previous two being Greencoat UK Wind and a renewable infrastructure group. Firstly, we need a quick overview of the company. GSK is primarily a pharmaceutical company with a market cap of £75 billion, and they split their company into three main branches. First is their pharmaceutical branch. They make drugs for a wide range of illnesses. They have a strong R&D pipeline focusing on immunology, human genetics and other advanced technologies. This branch of their business generated £17 billion in sales in 2020. Next is their vaccine branch. GSK are the world's largest vaccine company by revenue. They have over 20 active vaccines and supply over 160 countries. Vaccines made by GSK prevents 2 to 3 million deaths a year. They currently have a COVID vaccine in phase 3 trials. In 2020, vaccines generated GSK £7 billion of sales. Lastly is their consumer healthcare branch. They're one of the world's leaders in over-the-counter healthcare, with sales of £10 billion in 2020. Here are some of their products. They have Sensodyne, Parodontax, Polydent, Advil, Voltarol, Panadol, Otrivia, Flu, and Centrium. Let's now look at GSK's past performance. Here is their share price graph over the past 5 years. As we can see, there hasn't been any real growth, with today's price sitting slightly lower than the price 5 years ago. However, GSK has been paying an 80p a year dividend since 2014. When these dividends are added to the share price to show shareholder return, there is a slightly better image of the company, although not amazing. Shareholder return is just over 20% for the past 5 years. This is just 4% a year on average. As a result of no large share price movement and no change in yearly dividends, GSK's dividend yield has remained fairly consistent, hovering from high 6% to just below 4%. Based on GSK's current earnings, they do currently have a payout ratio of around 70% to support their dividend payments. GSK has had strong sales growth over the past 5 years, with an annualized growth of 4.44%. A large majority of this growth has come from the consumer healthcare branch of the company, which has seen its sales more than double in the past 5 years, going from 4.6 billion in 2016 to 10 billion in 2020. GSK's vaccine branch has been lacking growth in the past 5 years and has been overtaken by the consumer health care branch as the second biggest branch. They do currently have 9 vaccines in phase 3 clinical trials, which may help this branch in the coming years. GSK's most recent financial results are for Q2 2021. You can see strong growth across all 3 branches. Q2 2021 data is compared with Q2 2020 data, which is why there looks to be a very strong vaccine growth. However, the vaccine business in Q2 2019 was at 1.6 billion. This then dropped to 1.1 billion in 2020 due to the coronavirus pandemic, and has since recovered this year back up to the original 1.6 billion. So the 49% figure can be a bit misleading. This is similar for the pharmaceutical branch. Sales have recovered rather than grown past pre-pandemic levels. The consumer healthcare branch has continued to grow at similar rates seen before COVID. Here we can see the recovery of all 3 branches versus the 2020 levels, as well as seeing the heavy impact of exchange rates has had on GSK's performance. As mentioned earlier, GSK currently has 9 vaccines in phase 3 trials, alongside 13 other medicines, with a total of 63 potential vaccines and medicines that could be taken to the market, with 6 of these being COVID-19 focused. GSK's CEO has received a lot of criticism since taking over in April 2017. A large amount of her criticism is due to her not being from a pharmaceutical background, as well as her inability to raise the share price since taking over. Her vision is to split the company into 2, a new GSK and a new separate company focused on the consumer healthcare branch. The new company will take on the high growth and high margins consumer healthcare business. The split is expected to take place mid-2022. The vision it will leave two more focused businesses. For anyone familiar with AT&T, the US telecommunications business, this company's split is structured in a similar way to AT&T's Warner Media split from the main company. GSK shareholders will receive 80% of the new consumer healthcare shares. As the split takes place, there will be a dividend cut. The two businesses combined will pay a 55 pence per share dividend, with 45 pence coming from the new GSK. This is compared to the 80 pence currently being paid as a company as a whole. Goals currently set for the new GSK are for by 2026 to be generating more than £10 billion from operations, representing a 10% compound annual growth rate. Then with a 2031 target of £33 billion in sales. Do note that all these financial outlooks exclude any COVID-19 related revenues. Elliott Management is an American investment management firm, which has recently built up a large stake in GSK. Elliott often buys shares in an underperforming business and then use their influence to instigate change. They believe that GSK can create value, and that they have struggled in the past with execution. Elliott has also expressed doubt into the current board of directors at GSK. Elliott Management show that GSK has vastly underperformed its peers, the S&P 500 and the FTSE 100, with almost all the figures on the graph representing to a negative total return comparison. I find this table quite staggering out of how badly GSK has performed compared to others, being 233% behind S&P 500 over 10 years. Elliott also highlights investors' opinions on GSK's management team, with GSK being the least favourite out of these selected companies. Elliott then goes on to show how GSK is very undervalued, showing a potential 45% upside. There is a general consensus that GSK has some value that needs to be unlocked, and it seems that the demerger is the board's method to unlock this value. So is GSK currently undervalued? Based on my own discounted free cash flow calculation, GSK has a fair value of £24, which is reduced down to 19.59 when the total debt is taken away from the fair value. This suggests that the stock is 32% undervalued, based on my calculation, compared with its current share price of 14.78. Simply Wall Street has valued GSK at £36 based on a similar discounted free cash flow calculation. That would mean that GSK is nearly 60% undervalued. Personally, I believe that GSK is undervalued, but not quite as high as 60%. GSK also has a reasonable price to earnings ratio of 17x, with the pharmaceutical industry average being around 28x, and the UK market being 23.4x. So in conclusion, I personally believe that GSK stock has multiple positives. It does appear to be undervalued on both the discounted free cash flow and PE ratio metrics. They currently have a high dividend yield, with the new GSK likely to have a progressive dividend policy. I have also put the company's demerger as a neutral, as I can see it being a positive for the company in terms of growth, but also do believe it will introduce more risk and volatility to the company post-demerger. I have also put the dividend cut as a neutral, as it does seem that GSK is slightly overpaying and is not using enough cash as it should be for R&D and other growth opportunities. This will, however, likely be a negative for most dividend investors. The main negatives of GSK currently are its fairly high level of debt, its high reliance on future drug and vaccine pipeline. This is similar to most other pharmaceutical companies. And lastly, its poor performance since Emma took over as CEO. Thanks for watching. Please like the video if you enjoyed and consider subscribing. Do also let me know your opinion on GSK in the comments below. And lastly, you can get a free stock worth anywhere from £3 to £200 by using my referral link in the description and signing up to FreeTrade.